12/12/2019. It is Monday morning. The markets are moving, and we're here with Tackle Trading's halftime report. We've got Matt, we've got Tim, we've got Cody. Matt, how are you doing today?
Tim, doing very good. Excited to be here with the crew, and a less volatile day than last Monday, but a little downward movement in price action as expected today.
You know, we've got a protest in Hong Kong. We've got a risk-off environment. Bond yields are dropping again. The yuan is rising, which is weakening, actually. The U.S. dollar-yuan cross-pair. Yuan is a weakening currency right now. But the IMF did come out and say they are not a currency manipulator, Matt. A lot going on in the news, most of it about China and the trade war. What is your read here on the chart on the S&P 500?
Well, just to go off on what you said about the IMF very quickly, the IMF came out and ruled that China is not a currency manipulator, that their currency valuation is in line with kind of the current state of economics. And we discussed that last week. China is a currency manipulator, but so is every other country in the world. And I think that's what the IMF really kind of said today.
Yeah, you know, the book of the month we're going to be reading is Aftermath, which is Rickard's new book. And I just got my copy. I think we're probably going to have a podcast on it sometime in September, Matt. A lot going on with those currency wars, obviously, and it's obviously right back in the news and in the forefront. We'll talk currencies here in just a minute. S&P 500 has got a red candle. Is this the first pivot confirmation of that bear pivot, Matt, or is that too early to call that?
If we close underneath 2,900, I would call that confirmation. Okay. That's kind of the low of where the inside candle on Friday happened. And so as you saw this snapback rally coming into resistance, you obviously have an inside candle here, which is called the bearish Harami candlestick formation. And when you're looking at the creation of a pivot, Tim, you're really talking about three candle relationship on a pivot. The first candle is when you have this big candle coming into resistance right here at that 2940 level, right where the 50-day moving average was. That is what we call a bounce candle. And then you have the pivot candle here, but that's only a pivot candle if we have that confirmation. And confirmation would be, for me, just technically confirmation is a close underneath the pivot candle being the inside candle. And so confirmation would have to be underneath 2,900 here. And that's exactly what you're seeing here. But nothing today was unexpected, Tim. I mean, in the scouting report meeting on Friday, I think we had about 200 picks total that we went through, that the coaches, and kind of what we mean by that, guys, is every one of the coaches at Tackle on Friday before the scouting report meeting, they basically go and they add their picks, what the stocks they're looking at that they think is a clean technical setup. And we had about 200 of those. And Tim, about 130 of them were bearish candidates, both in terms of bearish retracements, bearish breakdowns. In the newsletter over the weekend, we actually downgraded the S&P 500 into the negative territory at negative 45. And so we had a big downgrade coming into the weekend. We had more bearish picks than we had bullish picks. And so today was not unexpected. This is a bearish retracement that you were seeing here. And if we do get confirmation under 2,900, you should see price depreciation coming back down into 2,800, in my opinion.
You know, it's really interesting. We're going to go through all the different indexes. I think maybe the lead here today is going to be out of China and Hong Kong, Matt. The protests there where they stormed the airport and actually kind of got a lot of people arrested. There's obviously political unrest going on there. Bring up FXI if you would. And
I obviously that's all over the news, but those Hong Kong protests, Tim, has been going on for what, 2 months now?
Oh, yeah. Yeah.
I mean, this is not something that just happened over the weekend. I personally do not put any of the price movement in the S&P 500 on the Hong Kong protest. It is a slow news day, and that's just going to be the news. But this to me was a technical movement to the downside. It was not a behavioral movement. It was not a fundamental movement. It was not a geopolitical movement. I saw this purely as a technical movement to the downside.
You know, and one of the things that's on my mind right now is on a Monday morning, last Monday, we had a huge down day, like 3.5%, 4% on some indexes. Today, though, we're coming in over the weekend. And after last Monday, Matt, you recovered Tuesday, Wednesday, and Thursday. And the market has had many of these Mondays where you come in, you've got international risk, you've got some selling maybe in China and Europe because they open up before we do. Our market sells down, but then recovers and settles in. Do you see this week as different? Do you think there's more risk to the downside? I'm neutral personally, so I kind of see both sides.
I'm neutral in the market, but I will be trading more bearish trades this week than bullish trades. I mean, when I'm looking at the list, and there's about, of the scouting reports, I got about 7 that I'm targeting on the bull side right now, and on the bear side, I got 13.
Mm-hmm.
So out of the 20 trades that I'm looking at this week, 7 on bull, 13 on bear is kind of where I'm looking at. So I'm still in the neutral territory where the S&P 500 is. I mean, my bias is always going to be where the tackle trading newsletter is. If it's at a negative 45, that's where my bias is, at a negative 45. So I am slightly degree of left to center, but that's still a neutral rating. But this week, I mean, yeah, I'm looking to carry more bearish delta this week.
I see the risk. There's no doubt about it. And as you kind of balance your portfolio, if you have more bullish delta, you're going to bring some of those bearish trades in to balance that back towards zero or even slightly negative, depending on how you set that up. I think it's a good bit of advice, though. Start with the newsletter each and every week, Matt, because we've already done all of that work and all of that research in terms of kind of putting together the sector rankings and the commodity rankings and the currency rankings and all that kind of stuff. China about to break below support, if not broken below support here. This is bearish, just flat out bearish. I know we're ranged down here, Matt, but this trade war continues to escalate. I don't see any reason why this would not continue to hit new lows.
Well, and I also don't see any reason why the trade war won't escalate at this point, right? Mm-hmm. I mean, it's getting worse, not better at this stage in the game. And when you're looking at the Chinese index here, Tim, obviously the gap down coming in last week, and then a little bit of fade coming into today. You're sitting right now at a very major level of support right here at $38. You break $38, you're down to 36 within a week. That's some opportunity on the bear side, both and that's Chinese tech companies. That's Alibaba, that's Baidu, that's the VIPs. Those are those Chinese tech firms. And so there's going to be some shorting opportunity if we do confirm underneath 38. That is a major level of support for the Chinese index. When you're looking at this on a daily chart here, Tim, you see the kiss here, you see another kiss here, and then it's forming a little bit of a low base type situation right here. A close under 38 to me would be significant.
Bring up the USD CNH cross pair while we're talking China. Let's kind of all bring it together here right now. The People's Bank of China, they actually set the midpoint here, the pegged rate at 7.02, but actually here on the free market, Matt, it's trading at 7.09. They're not even able to kind of hold that peg. Clearly bullish, dollar bullish against the Chinese yuan. What does this actually mean for people to kind of process? I mean, not everybody trades currency pairs. As China is a net exporter, why do they want to weaken their currency?
Very simply, I mean, you just said they're a net exporter, and as we're put on as we put on tariffs on China, that's going to hurt their economic ability to sell products to the rest of the world. Well, what China needs to do to offset those tariffs is they need to devalue their currency to offset the economic problems of the tariffs on China, and so they devalue their currency so that they can sell more goods to maintain their economic standing in the world.
Yeah,
it's not difficult economics here.
Yeah,
to put tariffs on China. It's gonna hurt the Chinese economy. China downgrades their currency to offset the tariffs. It's really as simple as that.
Let's keep working through the indexes one at a time here. Dow, NASDAQ, and then the Russell. Give me a quick technical read. They obviously all have.
Let me break down the intraday very quickly on the S&P 500. Looking at the 30-minute chart here, just showing you kind of the cash open versus the overnight action. This is the overnight action when the futures market kind of opens up. You really didn't see any problems in the market until the European market started opening up. And when the European market started opening up, there was a little bit of information coming out of Italy that Italy might be thinking about leaving the Eurozone. Italy comes out and says, no, that's fake news. But that obviously showed a little bit of weakness on the overnight once those European markets started opening up. And then the cash open right here in the US, you've really not seen any type of price action. The S&P is really trying to hold that 29 level. Currently, the low of the day is at 28.90. Keep an eye on that 28.90. It played a role over here in the intraday from a resistance and a support level. If you break 28.90, you should see further depreciation and price action today.
Volatility does settle in about midday, though. Sitting on support, a breakdown would be significant, especially heading into the close. There's no question about it. Matt, I think it's a coin flip on whether you rally, you hold, or you sell here, even on a Monday. I don't see a lot of catalysts that are going to drive it. I wouldn't be surprised at kind of a fading action throughout the rest of the day.
Yeah, there's not a lot of economics today, and there's quite frankly not a ton of economic news coming out this week. I would say slightly down. If I had to say one way or the other, I'd say down from here.
Yeah, interesting. And we'll obviously revisit this by the end of the day. Take a quick peek at the other indexes, if you will. Dow, NASDAQ, and Russell. I'm seeing relative weakness in the Russell here today. The Dow looks almost identical to the S&P, and I think the NASDAQ actually is holding up a little bit better. Tell me if you see any subtle differences in these charts.
The subtle difference here is you're already underneath the low of the previous day. That would be confirmation on the downside in the Dow. A little bit weaker than the S&P, but that's about it.
Yeah. Yeah. So the Dow a little weaker than the S&P on a chart perspective.
To answer your question, when does Europe open? It's really kind of the European banks. When it's not really the European stock markets, it's really kind of when the European banks open, and that's when you start to see economic news come out. And that is at about, for Frankfurt, Germany, that'd be about 2 a.m. Eastern Standard Time. It's about midnight my time. The London Open is the biggest open out of the European zone, and the London Open is at 3 a.m. Eastern Standard Time, 1 a.m. my time in the West, in the Mountain West.
You know, if you had to buy one index here, Matt, would it be tech? Because I'm looking at some tech names. I know they're all in lower pivot lows, and maybe you're just adding bearish delta here today. I do see relative strength, and if it did break above that pivot, I like the upside here on tech. Is it just too big of a mess for you? Are you staying neutral, staying away from it?
No, I mean, I'm looking to trade bearish candidates this week. I don't care what the index is. I mean, you're splitting hairs on the Dow versus the S&P versus the NASDAQ right now. They're all looking very, very similar from a technical formation. Yes, the NASDAQ showing a little bit of relative strength today versus, say, the Dow and the S&P. So if you're looking at that just from today's price action perspective, you would have to say the NASDAQ 1, S&P 2, the Dow 3, and then the Russell 4th. But you're really splitting hairs. When the market starts selling off initially, the indexes, especially those three major indexes, the Dow, the S&P, and the NASDAQ, they all kind of trend in line with one another, right? And then they start to separate over time. But initially, when those sell-off happens, everything sells off, everything recovers, and then it starts to segment. And I kind of saw that in the charts when we were going through all the scout reports. There were some great bull picks, great bear picks in every sector, in every index out there. But the indexes themselves are really trading in line with one another.
Yeah, definitely a stock picker's market. There's no question about it. Update your bull list, your bear list. I mean, that's what I always do on a Monday morning, Matt, especially coming in over the weekend. You got all the reports, you got all the candidates from the option, the stock report. You got to build them in and see what they're doing, because you're going to get triggers on a Monday. And if you're not prepared, you're going to miss out on some of those opportunities. There's no question about it.
Oh, there's on the bear stock report and the bear options report. Yeah, there's a lot of stocks that already triggered.
Yeah, you had to be ready for them. There's no question.
Well, that's why you got to do your job over the weekend, Tim.
Correct.
That's why you have to do your job as a trader over the weekend to prepare for the week that's coming up in the marketplace. You can't wake up on a Monday and say, what should I trade? Right? You should have a plan that you're ready to rock and roll with. And, for me, in terms of cash flow, it starts with covered calls and naked puts and boomerang trades on tackle 25 stocks and the dirty sexy money list I like to do boomerangs on. For me, it's in terms of the reports, I always start with the reports. And I've said this many times. There's probably a rock solid 30 to 40 stocks that are setting up from a really good technical situation in those reports this weekend. And if you're coming in on Monday saying, well, which should I trade? You're typically behind the eight ball.
I think you're late to the party at that point. Doesn't mean you don't get triggers through the week, because you have to come back and update those day by day by day by day and see what's going on with the markets.
Why do traders miss trades, Tim?
Lack of execution on their daily routine and their preparation. They're not organized.
They lack execution on their weekly routine, which is Saturday and Sunday, spending an hour in front of the market, preparing for the week that's coming up. That's number one. And number two, they don't show up.
Correct.
Right? They just don't show up. And then a trade that triggered 3 days ago, they finally come to the market. They're like, oh, that was a really good trade 3 days ago. I'm going to make it today. And it's like, no, it's already ran. The trigger already happened. You got to show up and do your routine.
I'm concerned about a breakdown on the Russell. In fact, pull this back on the weekly, Matt, and I do cash flow. If it does break support, you've got a lot of downside here. Concerned about heading into the fall, heading into the volatility times where the market tends to have a little bit more craziness. Now, I know we don't have like key Fed events this month or anything like that, but the trade war risk, the market kind of rolling over, we're riding that falling 200 period moving average, and you've got major support down here. What's your read on the Russell?
Russell's the weakest of the bunch. There's no doubt about that. It's been the weakest of the bunch for since really kind of last October, to be perfectly blunt. I mean, it led the charge to the downside, and it's never really recovered to the same degree that the S&P and the Dow and the NASDAQ did. You're looking at a fairly similar technical formation, but a lot more strength on the downside coming into the Russell 2000 today. And 1500, even though it hasn't really played that big of a role from a technical perspective over the course of the last month and a half, 2 months, but that is a significant whole number. And if you close underneath that, you should see some price depreciation and some really good bearish opportunity here in this index.
Let's move on to commodities.
Question I have for you though.
Yep.
Okay. You do more cash flow condors than I do.
I do them every month.
Right. You do them every month. I do not do cash flow condors every month, but you do every month. Are you so concerned here that you may hedge?
I'm not going to hedge at this point today, no, because I've got quite a few hundred points cushion here.
Yeah.
I think there's a couple of mistakes people make out there. And, you know, we do our mastermind group. This Wednesday, actually, we have our Cash Flow Condors mastermind group, always third Wednesday of the month, kind of to prepare for that October trade, because we're going to be right in that sweet spot on that 65-day window. There's several things I want to kind of highlight here. Number one, hedging is something I think you need to learn how to do, whether you do it or not on any one particular situation. That's trader judgment. There's no question about it. If it broke support, I would hedge, number two. And then the third thing is, Matt, and I've noticed this mistake with traders recently, is they're not following the rules. You know, I saw a post in our clubhouse where somebody had said they were following the cash flow condor rules and they'd put on a 30-day trade, you know, or something like that.
It's not cash flow condors.
It's not the rule to the condor.
Cash flow condors. And let me explain that for a second. Okay.
Yeah. Yeah.
When you put on a 30-day trade at a 10 delta,
yep,
you can't get far enough out of the money to justify the data on the back testing. Okay. You're going to be way too often, you're going to be making management decisions because the probability based on delta versus the probability of touch is very, very different. But when we back tested this system, Tim, it was that we needed to sell on the put side 10% out of the money is what we needed to sell. And the only way you get 10% out of the money typically is when you sell a 45 to 60 day number. And the majority of those times, and it depends on volatility at the time, but the majority of that is typically around a 60-day number, right?
Correct.
And some traders will do, you know, every 30 days, they'll put on a 60-day trade every 30 days.
Two rolling trades. Yeah.
They'll have two rolling trades.
Yep.
But they don't do every 30 days because that actually breaks the system rules. And I understand why some would do that because most credit-based systems, they want to take advantage of the theta. They want to take advantage of that last 30 days. But in some options, when you're so deep out of the money, theta responds a little bit differently to the decaying asset. And when you're selling 5 deltas and 10 deltas, that theta does impact it a little bit differently than a 30-day number. And so for probability reasons, for backtesting reasons, for theta reasons, that is why we did a 60-day number. And it amazes me, Tim. It amazes me that people, when they come into learning how to trade a system and then they start making modifications to the system, it's like, oh, wow, you don't understand the back testing that went into that system.
That's right.
I mean, think about it. Don't you think we back tested a 30-day system with the 10 delta? I mean, of course we did. We back tested 5 delta, 10 delta, 15 delta, 20 delta. We did it on a 30-day time frame, 45-day time frame, 60-day time frame. And this took literally a year, like literally a year. And then people come in with very little understanding of systems and trading, like, oh, well, I just want to do a 30-day system. It's like, okay, then go make your own system.
Well, and then another mistake.
Don't come to us and email us and crying to us when you're breaking rules.
You can't break the rules, and you got to understand the rules. You got to go through the whole process. There's no doubt about it. Another part of those rules, Matt, where I see people make a mistake is 10 delta is the maximum that you should or could take based on the back testing. But the rules actually kind of have a guideline that you want to go the lowest delta you can, as long as you're still picking up a 50-cent credit.
I would much rather do a 5 delta than a 15 delta.
100%. I'm looking at the October options right now, by the way, and I don't want to go too far down this rabbit hole, but the 10 delta is at 1,300 strike price on the RUT, but you can actually get a 10-cent credit on the 1250, 1240. That extra 50 points cushion to still get a legitimate 10% ROI credit would be much, much worth it to go to a lower delta, which would put you more at a 6 delta, you know?
Yeah.
So that's another thing I see mistake on quite often. By the way.
You start by identifying that 10 delta, and that's right there at that $1,300 strike price, right?
Yep.
Like, okay, I got a good 200 points of cushion here. That's fantastic. And I'm getting, we'll just say I'm getting 85 cents credit, right? Which is a really good credit on a bull put spread with the 10 delta. Well, I might say, well, I'm willing to give up a little bit of that really good credit to maybe come down and get me an extra 15 points of range here. And if I can get, say, a 50-cent credit and give me a little bit of 50-point more range, I might give up that $35 for 50 points of additional range.
In my opinion,
what you never say, Tim, is let me go up to this 15 delta and let me get, a massive credit of, whatever it is, right? It's just, and that was a 5-point delta, but you get the point. You start, the rule's the max. 10 delta is the max.
Yeah.
Right.
Yeah.
You can always be more conservative. You can't be more aggressive with the cash flow system.
Well, it's the same thing with naked puts and cash flow in general. In fact, in the chat here, guys, type in the words cash flow. And I think there's a maxim here, cushion over credit, right? You should always make sure that you're getting as much distance as you can to make the trade an easy executable trade instead of trying to chase the ROI and the numbers. Because if you make...
Well, what I was going to say to just go off on that, Tim, is just fill out the theta research spreadsheet.
Yeah.
It'll show you the ATR buffer, right? Yeah. And when you're comparing the ATR buffer to the ROI, and let's say the ROI and the ROID is in the green and the ATR buffer is in the yellow. Well, that's an indication, according to the spreadsheet, that you may be willing to give up a little bit of that ROI, sell a little bit of a less delta to get a little bit better of an ATR range. And when you're in your first 6 months of trade credit spreads, you get so excited over the ROIs and probability projections, right? Yeah. So excited because you're like, oh my God, I can get a 20% ROI on an 80% probability. All I'm going to do is do that, right? And then you do that, you're like, oh, one credit spread just blew up 4 other credit spreads, right?
Yeah.
You can always lose more on a credit spread than you can make. And as a veteran trader, almost every veteran trader will be like, no, I don't want to sell a 20 delta. I want to sell a 10 delta. I want to sell a 5 delta. I'm willing to give up some of my ROI projection for the higher probability. And it's not just the higher probability. It's the fact that you don't have to manage those trades nearly as much. If you sold a 20 delta on the Russell 2000, Tim, you're hedging that right now. Right now.
Yeah.
You sell a 5 delta, you sell a 10 delta, you're like, hey, I still got 200 points of cushion.
By the way, Adam Drillon just put something in the chat that made me chuckle, but I will not repeat it. It is well, Adam, rowdy traders. I'll tell you, I get it. Say la vie.
That's a Wall Street trader right there, Adam.
That's right.
That's straight out of the Wolf of Wall Street, buddy.
Yeah. Back on the charts. Let's go through the commodities if we can here, Matt. Crude oil, Brent oil, all the different energy sector type stuff. Did you see that news of Saudi Aramco wanting to go back and IPO again this year? I know they had.
Did. Yeah. I did. Saudi Aramco announced this morning they're ready for their IPO again. It's going to be interesting. It would be the biggest IPO in world history.
Yeah, be the biggest company publicly traded, by the way. I mean, they're bigger than Apple and Amazon and Google.
I'm looking forward to trading it.
Yeah, absolutely. Yeah.
I might not invest in it because it's Saudi Arabia.
Mm-hmm.
You know my stance.
Yeah.
But I definitely would trade it.
Yeah. What's your read on the dollar here, Matt? Because that's going to drive all different commodities, obviously. The news out of China, they're trying to devalue the yuan. The dollar's rallying against the yuan, but it's not rallying against the basket of indexes, kind of back into a neutral range. What's your read?
Yeah, I'm still slightly bullish on the dollar. When you break down the individual currencies, I think you got some strong setups on the dollar. Mm-hmm. But if from a basket perspective, you're certainly in some neutrality here. I personally still slightly bullish on the dollar at a positive 35. That's where we put it in the Forex report this week. But you do have some neutrality here.
Yeah, I see some of both. There's no doubt. You do have a higher pivot low relationship developing, and you have the assumption that the dollar is still the best of a bad bunch. I was doing a piece on currency in my class last weekend, Matt, and the question came down to, would you still own the dollar? And I would say absolutely. I mean,
100%.
100%. I still think it's a strong currency in that regard. I understand we live in modern monetary madness, which is going to be your fantasy football team
My
name.
fantasy football name for the Trading Justice podcast is Modern Monetary Nightmares.
Modern Monetary Nightmares.
That is my name of my fantasy football team.
Yeah, I'm Ben Bernanke's beard or something like that. I can't remember.
I don't think it was beard, buddy. I don't think that's what Mark gave you in the podcast. Listen to last week's podcast if you want to know Tim's name for his fantasy football team that Mark gave him.
I see.
Tim asked me to ensure that it got edited out, and I kindly said no.
Yep. Dollar, obviously, kind of in a mixed relationship. You're still bullish. I'm a little bit neutral, but it doesn't mean I'm bearish on the dollar or anything. It would not surprise me for it to break back up above that pivot. And there's a lot of really good currency relationships here that are setting up in that regard.
Like take this one, for example, here, US dollar, Swiss franc. Okay. Real clean, easy trigger under 97. Projection has to be down here. A little bit of fade action coming into that trigger, fade action underneath. Look at the British pounds versus the US dollar here. Okay. Showing tremendous weakness against the dollar, just broke down literally on Friday. And then it kissed off that same breakout channel here today. So you do have a lot of currencies that are really, really weak against the dollar. And that's kind of why when I look at the individual components, it's kind of like when, you're looking at a sector, Tim, and you have a good technical read on the sector. But then when you go break down the individual components of the sector, it changes your opinion a little bit. And that's kind of where I'm at on the dollar right now is when you look at the index itself, it's volatile, it's crazy, it's a little bit of up and down. Are you bullish? Are you bearish? Slightly bullish, neutral, all that jazz, right? But then you break down the 7 major components of that index, and it gives you a little bit of a different read. So out of every currency, how long would it take us to answer yes to the dollar? 1 second. But at the end of the day, you got to read the chart. And right now, I got a slightly bullish reading on the chart because of the individual components.
Cody, you did the Forex report over the weekend and you broke them all down. Which of the currency relationships do you think is set up in a way to where you're going to trade it soonest this week?
So not necessarily the US dollar, but a different crosspair. That would be the Aussie, Japanese yen. And I pointed that one out on the Forex report. And if any of the newfound Forex traders that have been watching me listen to that, they should have caught that break right there. And that's one of the better ones right there, which also on there, on the gridiron, we have the Aussie dollar and the Japanese yen on opposite sides. So when you look at the two of them, it just strengthens the trade a little bit more that way too.
Yeah, the yen is also a safe haven currency for that area as well.
Yeah. So trade war risk, Matt, this is a very simple idea. If you understand currencies, you're selling the Aussie, which is sensitive to trade through China, obviously.
Very sensitive to trade through China.
You're buying the safe haven, which is the yen. That makes sense. That was a really, really good setup. And obviously weakness here today. Very good. And obviously check out that.
Probably would have been a little bit weaker if South Korea didn't come out and say Japan's not a good trading partner either.
Well, yeah. I did not see the headline on that one. Was that Kim Jong?
South Korea, it's not Kim Jong-un, but South Korea came out and they basically established 2 different versions of trading partners. And they said, okay, here's all our good trading partners. They're in this basket. And here's Japan, is what they said. And so just a little bit of a shot at Japan from South Korea today. But from a fundamental perspective, this makes a lot of sense. Australia is very, very, very prone to trade war risk. They do 30% of their entire economic data comes out of China purchasing Australian goods. And so they're very, very prone to Chinese weakness, international trade weakness, and Japan's a safe haven. I thought it was very good analysis by Cody in the Forex report.
By the way, if you're watching right now, we are 5 people away, I believe, from topping 40. Where's our 4,900 subscribers? We're going to hit that 5,000 mark here soon, Matt. When we started this halftime report last year, I think we're about 2,500.
About 2,500.
Doubled our audience this year, which is great. We love bringing the value here each and every day.
And thanks to everybody who goes out and says, "Hey, listen, go check out those tackle trading guys."
Yeah.
Love the team.
If you enjoy our show, if you enjoy our channel, give us a quick like, give us a share, subscribe if you are not subscribed as yet, and make sure you click that bell so you can get alerted for future shows. Let's go through all the commodities: crude oil, gold, silver, some of the major ones that are catching your eye. Obviously, crude oil in a fading downtrend here. Lower pivot low, lower pivot high, lower pivot low, lower pivot high. We did hold support down there, Matt. It did hold it last Thursday and Wednesday as well.
Not surprising either. I mean, support's there for a reason, and crude in this nice little downward movement in price crude has had. Crude comes right back down into that lower level of support. But Tim, if you understand kind of potential average yield and where these support levels will form, if you look at crude coming from, 60 and a half down to 55 and a half, we'll call it, that's a $5 price movement. Then it goes from 58 and a half down to 52, which is about a $6.50 price movement. So when you're looking at those potential average yield, you're at the lower end of your range here. And then when you kind of look at that from a range perspective, and you see these support levels over here between 51 and 52, yeah, crude's going to retrace at some point. And now you're retracing right back into the old level of resistance right here, significant whole number at 55. It's going to be interesting to see what crude does here, Tim. Give me a doji on crude at 55 and a downward movement in price. 50 and 51 are in target at that point.
What do you think about a bear call spread here as well? I mean, it's got so much resistance above it. You've come up 3 days on the candlesticks. You're now hitting into an old support point. You got old lower pivot highs in this for the last several months, Matt. I kind of like the idea there, bear call credit.
I could be signed up for a bear call credit, but when I'm doing credit spreads in futures, Tim, I treat them a little bit similar to how I treat a swing trade in the step system.
Yeah.
I don't just play zone defense. When I'm doing credit spreads in the stock market, I'll play zone defense. But when I'm playing credit spreads in the futures market, give me a pivot, give me a doji, give me a downward movement in price, and then sell that bear call spread.
You'd still wait for the delta confirmation.
I would wait for delta confirmation on credit spreads or naked puts.
Yeah.
On futures.
By the way, Brent, natural gas, gasoline, all the other energy type commodities that we track in the commodity report, we had a more bearish rating on than crude oil. Do you think they drag them down and bring crude oil with it? I mean, BZ is just flat bearish. I mean, it broke below support. We talked about the relative weakness last week. A much different chart on this BZ.
It's a bear flag too.
Oil. Yeah.
Yeah, it's a bear flag. And if you're looking to short oil at any point, you would probably look at Brent more than crude right now because it is the weaker of the bunch.
Yeah.
With a better technical setup too.
Yeah, I agree with that as well. Natural gas looking pretty ugly still.
Pivots, wait for confirmation, all that jazz. That's the disclaimer. But yeah, both of these have to be projected down.
By the way, if you're out there, you're an investor with an IRA and you're looking for a plan, something that you wanted to dig into for some time, the commodity report has highlighted and featured the boomerang trade for the last 2 months. Yeah. If you've not been watching those commodity reports, I would definitely go back and make sure you're getting the value out of that content. Mark does a really, really good job with that.
Well, we do a lot of boomerangs on commodity ETFs and commodity stocks and, so on and so forth as well.
Well, we had that boomerang podcast just about a month ago or so, I believe. I'd have to look up the episode number. Gold and silver here, quick, Matt, if you would. Obviously, gold bullish.
Gold bullish.
Yeah.
Gold bullish, overextended, high base, but look at the beauty. This is what I love. This is what I absolutely love. Clean triggers. And that's what I'm kind of seeing here, Tim, in the chart. You see how these wick relationships all kind of hit into the same level? That's not random. That's algorithms is what it is. People don't do that. Algorithms do that. And when you drop this down into a 30-minute chart, you really see that level right here at 1520 by 1522. You see a very clean chart here, very clean high base starting to form. And with all the craziness in the world and the geopolitical situations and the trade reasons and fear of recessions kind of kicking up again. And, it's like I said before, gold is not just an inflationary asset protection. It's a safe haven asset protection as well. And you're seeing a lot of defense here being played on gold. And you got to love that clean trigger, Tim. It's an easier trigger than anything that was happening here at 1425.
Surprising statistic here of the day, palladium is still up more than gold is year to date, 19.6% relative to 18.5%, but we've been more bullish on gold now for a while. Platinum actually year to date, if I got a number here, up 7.7%. Palladium's been a little bit stronger. All the metals have been running. I mean, there's no question about it. Take your pick. Silver has moved really, really bullish in the more recent action, but palladium had a good run. They also started from a lower point all the way back down there to about 1200.
I'd still give me that has a pretty decent trigger on the upside here on palladium too, but give me gold and give me silver above any of those right now. I will tell you the one that kind of stands out to the downside. What's heating oil?
You
Not
mean
heating oil,
copper,
but HG.
HG.
Okay. The one that stands out on the bear side, and this is what we call a picture perfect bearish retracement, Tim, is copper futures.
Yeah.
Copper is just in a tremendous bearish downtrend. It retraces back up into the old breakout channel right there at about 2.6, downward movement in price. That is perfect confirmation if we close underneath the low of today. So, not every of those metals are going, gold, silver, doing amazing. Platinum, palladium, kind of, slightly under that. Copper's just getting destroyed, and I expect it to continue to get destroyed.
Which,
and it
by
has
the way,
a lot of trade risk too. Copper has a lot of trade risk.
100%. And I think there's a really good lesson here as well, because you take a couple of my favorite companies, the gold miners, you think of gold miners, some of them are sensitive to copper mining. See, the GDX is doing amazing, but then a company like Freeport McMoran Copper and Gold, Newmont Mining's doing great. It depends on what those mines actually pull out of the ground, Matt. You have to know that.
Gold.
Yeah.
Okay, Barrick Gold, Newmont Mining, GDX has the gold miners, and then you have FCX, right? And you're looking at trading, copper to the downside, and you're asking yourself, well, how do I trade copper to the downside if I don't understand futures? Well, what does FCX do? They're copper.
Yeah.
That's why this chart looks so bad in comparison to GDX. Is even though Freeport, even though Freeport does some gold, they're primarily copper. Yeah, I wouldn't touch FCX right now.
No, it's down at the bottom. We do like it from a long-term perspective, but the trade war has dominated the headlines this year. And in the chat, everybody type in trade war, because the answer to almost every one of these technical setups has been about the trade war. I did see some interesting commentary from Goldman Sachs over the weekend, Matt. I don't know if you saw that, where they said basically avoid goods-based companies that produce things because they're going to be more sensitive to international trade, and buy service-based companies that just create things but aren't necessarily a physical product.
So basically, Goldman said buy the U.S. and sell China.
Pretty much.
I mean, we're a service provider. They're an industrial, right?
Yeah,
okay, they're a manufacturer. There you go. GDX here, Tim. Keep an eye on GDX too. Clean trigger above 30 is there.
It's been a real good bullish candidate and running. Quick look at cryptocurrency and Bitcoin, if you will. Hanging around, Matt, just hanging around up here, 11,400 on the actual index. NG's been bearish.
Real quick. Oh, that too. 2.2 is trying to hold.
It's trying. It's got some momentum slowing characteristics down there. I don't trust it yet. It's got to have a lot more data for me. Bitcoin, I don't see anything here. Neutral in a range.
Nothing to see.
Okay. Let's break down the sectors. We do it each and every Monday, Matt. And I know we've got some rankings. We've kind of moved a lot of those more aggressive risk-on type sectors into a more neutral or even slightly bearish category. Some are holding. Give us a quick analysis on all of them, if you would.
Yeah, first and foremost, we always start our sector rankings with kind of understanding where the S&P 500 is. We gave the S&P 500 a 20-point downgrade for the second consecutive week. Those are pretty big downgrades for us. We typically do not like to move radical one way or the other. A lot of times we'll upgrade 5 points, 10 points, or downgrade 5 points, 10 points. A 20-point downgrade for us means we're seeing something technically in the charts that we are not comfortable with. Yeah. And we are not the type of individuals to radically alter rankings in any capacity. Tim, it takes a lot for us to remove a stock from the TACO 25.
Correct.
A lot. I mean, you have to have fundamental problems, not technical problems. You have to have massive fundamental problems. And so when you see us, downgrade 20 points, it's because something we're seeing technically in the chart is really, really concerning to the coaches at TACO Trading. And obviously with the S&P 500 forming a bearish retracement and now, kind of coming underneath that 2,900 handle. I saw Coach Noah put on Twitter, 2,900 had like a scary little gift to it. It was quite funny. Well done, Noah. But we gave it a negative 45 ranking, which is left of center. It's not a bearish ranking. It is a neutral ranking with a lean, an edge towards those bearish candidates. That's when we start, and then we kind of compare every sector against what we're looking in the S&P 500. And I'm going to start first with the aggressive sectors here. First, Tim, technology bearish retracement coming into the 9 EMA as well as the 50-day SMA. We ranked it, got a big downgrade, kind of following the S&P 500. And that's when I saw in a lot of these sectors, the aggressive sectors, really kind of doing in line with what the market is doing. And I talked about that earlier today, where when you have these bearish type movements in the marketplace, most sectors will immediately do it with whatever the actual market index is doing. And then over time, they kind of separate themselves. And so you're going to get a lot of negative 45 rankings out of the aggressive sectors because they look exactly what the S&P 500 is doing. Personally, I'm a little bit more bullish on technology than the S&P. You have a much better trend coming into this. S&P 500 was all the way down here. Technology, even though it's forming the very similar bearish retracement, does have a little bit of a more bullish tendency in the chart from an overall trend perspective. But because of the retracement, looking very similar to the S&P, we gave it a negative 45 on technology. Industrial is very similar to what we're seeing in that index. Looks almost exactly like the S&P 500 here on the industrial index. I mean, take a picture. They look very, very similar. Negative 45 rating on the industrial index. Communication, very similar at the negative 45, acting very similar to technology here. Technology and communications are trading very, very similar with one another. You see a little bit of a retracement, bearish retracement, coming back up into that very significant whole number at $50. Downward movement in price on Friday. Confirmation on the gap down on today on communication. Projection has to be down from here in communications. Keep an eye on your social media companies, your entertainment companies, your internet providers. That's all those communication companies as well. And then your next sector, consumer discretionary, it's going to be, I'm going to sound like a broken record because these all look very similar to one another. Big upward movement in price after the violation of support on discretionary, hit smack dab into that 50-day moving average. Real weakness coming in on Friday, gap down and trade down from the cash open in the discretionary space. Projections should have to come back down into that 114 level. Basic materials, a lot of your gold stocks, a lot of your silver stocks, a lot of your copper stocks, a lot of your oil stocks as well. Basic materials is not just gold, or it would be skyrocketing. You do have slowing momentum and trend, breakdown of support, bearish retracement, projection has to be down, and I'm still buying gold and I'm still buying silver because this index, this ETF tracks a lot of different companies that pull things out of the dirt and not just mining companies. Base materials got a big downgrade down to the negative 40 territory on base materials, which is on the edge of slightly bearish, Tim. It's a neutral rating on the edge of slightly bearish. And then the worst sector that we've had just ranked, left of center for weeks and weeks and weeks now is your energy sector. Energy got a downgrade into the negative 20 territory. Not as big of a downgrade because it was already in the negative territory, but it did get a downgrade into the negative 20. Keep an eye on $58. I know it's got a low point at 57.15, but if you look at the intraday here on energy, you can kind of see where that $50 right here, $50 right there, 58, it's going to play a role. So keep an eye on 58 and how this ETF in this sector handles the 58 spot. Moving on to your defensive sectors, and I think there's only 2 defensive sectors in the world today, but we do have 5 ranked by the S&P. The first one is real estate. Real estate the only sector that did not get a downgrade this week was real estate. Real estate, we maintained the positive 30, slightly bullish stance on it. We loved what was happening in the safe haven status here. It looks like it's breaking out. A nice confirmation above 38.63 should see greater price appreciation. And once again, for those of you who are new to the report, XLRE, full of REITs, high dividend paying type yield, and that's why it's one of the safest sectors out there. Is because it pays a massive dividend, very similar to its twin sister, the utility sector here. Looking at a lot of neutrality here. We did downgrade it just slightly to the 35 territory, positive 35. A breakout here is certainly tradable, and if you're looking for safety, XLRE and utilities is where you really kind of start looking for safety, both high paying dividend type companies and REITs in those 2 sectors. Looking at the next one, XLP, consumer staples, food-based companies. I'm still very, very bullish on XLP. I do think it's going to recover in time. This is I don't want to say it's a safe haven sector, but it does have safety in it with the type of companies, food-based companies that we need to spend money on regardless of what the economic situation is. At the time, we did downgrade it into the 40 territory, positive 40. So we removed the bullish rating because you cannot discount the fact that support was violated and it is forming a bearish retracement, very similar to what's happening in technology. but we still have a lot of safety there. So we downgraded it to the net, to the positive 40 territory, only a 5-point downgrade in consumer staples. Healthcare next. Healthcare is very aggressive, even though it does have a defensive categorization to it. It is very aggressive in nature. And when you're looking at healthcare, we downgraded it into the negative 45 territory. And as you can see, it has a very similar ranking to that of technology, industrials, consumer discretionary, because they do behave a little bit similar there as well. I personally have, I'm personally much more bearish here than I am on technology or industrial stocks or even consumer discretionary stocks. The violation last week of the 200-day moving average cannot be discounted here. Most of the sectors, most of the indexes in that bearish movement to the downside last week either held support above the 200-day moving average or hit the 200-day moving average. But when you're looking at healthcare here, you violated that 200-day moving average, and then you retrace back up into a decreasing 20-day moving average. Very negative from a bearish perspective on healthcare, negative 45. If it does confirm underneath that 200-day moving average, you should see price depreciation fairly aggressively, in my opinion. And then the last one, financial. I almost forgot about financial here. Financial, very similar to what we're seeing in the S&P as a whole. Financial got a downgrade into the negative 40 territory, and we should see how that 200-day moving average handles itself.
Love it. Love it. Obviously, there are tons of opportunities across different sectors. I think it would be an interesting discussion, Matt, maybe on a podcast to talk about why you only see those two sectors as defensive, because there are some that you can obviously throw out of there. Financials is one we've talked about in the past, as well as healthcare. Staples might still be in there, though, don't you think?
I would put staples there.
Yeah.
For me personally, the only three sectors that I have is defensive, and the S&P categorizes 6 and 5, right? 6 aggressive, 5 defensive. But when you're looking at how financials and healthcare specifically behave, they behave much more like aggressive sectors than defensive sectors, Tim.
Yeah.
Staples still, even though it trades a little bit like discretionary this year, it still has a lot of defensive type companies that we're going to spend money on regardless of the situation. The financial world, Tim, had an evolution in the 80s and 90s that really changed that sector. From the 1950s to the 60s to the 70s to the 80s, financial was the most boring space in the world because people paid their mortgage regardless of whatever the economic situation was. But people don't do that any longer. People will be more willing to give up their home in a recession than they would be willing to fight for that home because in 2005, 2006, you didn't have to put any money down to buy a home, which means you were very willing to give that home away because you didn't really have any skin in the game. And so the financial world really kind of changed in the 1980s when we really started stripping out the regulations, when we killed Glass-Steagall in the 90s, and when the subprime and when the greed of Wall Street really just kind of, hit to it the upteenth degree in the 2000s, that changed that space. And healthcare was very, very similar to that. Healthcare, we would take our child to the doctor. We would regardless of the economic situation. But over the last 10 years, Tim, as healthcare prices have skyrocketed and premiums have skyrocketed, and zero politicians have an answer to this, well, what's happened? That defensive space has now become very, very aggressive in terms of how the price action happens. And so from an aggressive versus a defensive perspective, yes, I only personally see XLRE and XLU and consumer staples as those defensive sectors, just simply because of how consumers have changed their behavior over how they handle the financial space and the healthcare space.
Yeah, I think there's a legitimate argument there. I mean, think about financials, though. If you split the insurance companies away from some of the others within the industry,
you can do the same thing in healthcare, though. Too.
I know.
You can do the same thing in staples. You can do the same thing in energy. You can do the same thing in any sector not named utilities.
Listen up, Standard & Poor's. Just call the Justice Brothers. We will set the sectors for you. We'll reset the whole thing, Matt. Yeah. We'll start over. Okay. We would come up with our own sector rankings and designations. It would actually make sense. We need somebody in the marketplace to kind of go through and clean some of that up because not all of it's
ETF. Well, the TT ETF. Tackle trading ETF.
I will tell you that I do think the S&P did a great job of creating the newly minted communication sector.
Yeah,
a lot of stocks that had no business where they were being listed, and so they created this new sector that really kind of put all these stocks together that made sense. So I did support that, right? The S&P It's not going to change financial and healthcare's defensive designation.
No, there's too many ETFs and whatnot tied to them, by the way. It would be a really, really big shift, quite frankly, if they were going to try to change it. Guys, that's our report here today. Couple things. Number one, we have a webinar on Wednesday, and I'm going to drop the link right here in the chat, Matt, as well. And if you are a pro member of Tackle Trading, thank you. You already know the value. If you're not a pro member of Tackle Trading, you should probably come in and join this webinar on Wednesday, Matt. They're going to be pitching the STEP system, I believe.
Mm-hmm.
Yeah,
they're going to be doing a webinar over the STEP system, and so they're going to spend an hour just kind of teaching the basic components of the STEP system. And then obviously, if you're not a member of Tackle Trading, you can get a 15-day free trial to come test out the STEP system and see what everybody's raving about. Because Tim, the reviews are off. The reviews are amazing.
Yeah.
The reviews are absolutely amazing.
I mean, that STEP system course is tied to our pro membership, and anybody who does get a pro membership can join it. This webinar this Wednesday will kind of highlight the value of it. And one thing that might be a great thing for you guys out there who are team tackle, who are halftime crew, who are here every day, send this link to somebody in your life who you think might enjoy tackle trading and get value out of the pro membership. They can register for the webinar and come and join us.
Tim, you said, yeah, we're going to be pitching the STEP webinar, and everybody's like, oh, sales.
We're not actually selling
here's
anything.
Here's our offer. How about 15 free days on us to kind of test it out and see what you think?
Yeah.
That's how Tackle Trading handles sales.
It's all value.
Here's free.
Yeah.
If you want to be a part of us, be a part of us. If not, don't.
The word pitch, it does trigger something, doesn't it? Or sales in general. I mean, everybody gets triggered so easily.
So scared of sales. No, embrace sales. Understand sales. We sell every single one of anybody watching this, anybody that listens to our podcast. If there's one thing I would recommend is understand, embrace sales. It will help your life out immensely. Yeah, it will help your marriage out. I'll tell you that right now.
Well, just life in general. It's communication. All sales really is communication and helping somebody find value. There's no question. Johnny, real quick, rapid fire only on Tuesday and Thursday in our halftime report. We are adding other sections to the other days. So be here tomorrow for rapid fire if you
Johnny, you can blame me for that. That was my call.
We're going to add different components to that. There's no question about it.
We're going to have different segments at the end of each halftime report that you guys will end up loving. And on Mondays, we do the sector rankings. On Tuesdays and Thursdays, we'll be doing rapid fire in the halftime report. We haven't figured out what we're going to do on Wednesday and Friday. So if anybody has any suggestions, let us know.
And Matt, some earnings, some big names actually this week. JD.com, Tilray, YY, Advanced Auto Parts is on my bearish long-term watch list. They have earnings tomorrow. Double check your companies if you're trading. You cannot make that mistake. Actually, we all have made that mistake where you accidentally hold through an earnings, but just a little organization, a little discipline to go in and double check things before they happen. Don't want to hold through an earnings report without some of that information.
Real quick, Tim, just go on that. One of my students sent me their trade journal, and he's doing absolutely awesome. And he had a little bout of confidence. And I looked at his trades, and 10 of the 11 trades that he had made in the past couple weeks were technically sound, just real technically sound. But unfortunately, he was on a flight when one of his trades had earnings report.
Oh, no.
And he held the call option through it, and it went up, and he still lost money.
I'm laughing because it's a shared experience. We've all done it.
I've done it.
We've all done it.
I started laughing like, yeah, I've been caught with my pants down on a plane on a trade before.
We have all been on a plane and had something happen where you don't have Wi-Fi or you forgot about it or whatever it may be. And c'est la vie, brother. I mean, that's the way it is. That's brutal.
Wait till you wake up at 3 a.m. on a nightmare like you didn't put a stop loss on a future strike.
Yeah. By the way, there are a ton of bear setups on the option report this week. If you guys are looking for bearish delta, I'm looking at the bear list just on the option report alone, Matt. There were 10 qualified picks. There's 1, 2, 3, 4, 5, 6, 7, 8 of them triggering today.
Yeah.
8 of them triggering today.
Of the 13 that I'm looking at trading this week, 8 have traded. 8 have triggered.
Yeah, I'm going to drop the option report link. If you're a pro member, go grab that. If not, sign up for a 15-day trial and go check out that option report. Good job today, Matt. Good job today, Cody. Good preparation. Always love going through those notes and that report. We will be back tomorrow, Tuesday at the same time. We're out.